Hello, and welcome to the 54th episode of Crossing Thin Ice. I'm Dave Ingram, and I'm joined as always by Max Rudolph. Today, we will be looking into what happens when the environment changes faster than our systems for managing risk. In this episode of Crossing Thin Ice, Max explores how climate-related events are testing the limits of insurance as a tool for resilience. As disasters become more frequent and severe, traditional approaches to setting premiums and spreading risk are being strained, sometimes to the breaking point. With recent turmoil in major insurance markets like California and Florida, this conversation looks at the tensions between actuarial thinking, regulatory constraints, and public expectations. We'll be talking about how we got here, what's holding us back, and what kinds of changes might be necessary to sustain risk sharing in a world of accelerating uncertainty. And please remember that what we present should not be taken as investment advice. It is meant to inform risk managers and to help you think about the risks that you need to deal with today and in the future. Let's get started.
Emerging risks are not a new phenomenon, but conditions seem to be changing ever more quickly. Mitigation of these risks is increasingly difficult. Homeowners pool their risk from fire and wind using private insurers. When claims are stable across time, the law of large numbers allows consistent premiums, with regulatory oversight ensuring profits are not excessive. But wildfires and hurricanes now generate increasing levels of damage, and the trend is expected to worsen. How did we get here? The environment is changing quickly, and some insurance regulators have made it difficult to properly set premiums. California wildfires and Florida hurricanes have highlighted these concerns due to their magnitude. Recent rate increases reflect the changing environment and inflationary pressures, and insurers attempting to balance rates with the risks accepted. Homeowners are required to procure insurance for most residential mortgages, and few can afford to self-insure. Broad coverage helps retain the value of a neighborhood after a catastrophic event, cleaning up the debris and rebuilding consistently. In California, the markets were in turmoil even before the 2017 record burns. The insurance department, led by an elected commissioner, until recently allowed only historical data to be used when calculating retail premium rates. Reinsurers have no such constraints, and rates they charge reflect increased risk associated with higher temperatures and drought. Some of the largest writers of homeowners insurance ceased new business sales as they felt unable to price policies profitably. Some left the market completely. Some of these regulatory restrictions have been lifted, and premium rates are rising quickly in areas prone to fire, even where none have recently occurred. A concern for consumer watchdogs is that premium increases are unnecessary and increase profits for insurers. This can be addressed with transparency, looking at profits over various longer time horizons. The current year profit will fluctuate, but over time, a sustainable market should stabilize. California operates the FAIR plan, fair access to insurance requirements, with lower benefits and higher premiums, providing a stopgap for homeowners who can't otherwise find coverage. If premiums are too low to pay for claims, FAIR can assess insurers in a way similar to the State Guarantee Fund, and has done so following the LA fires. If premiums in one insurer's block of business are materially low, this could create a spiral, with the most fragile insurers remaining, reducing redundancy for the rest. This incentivizes insurers to withdraw from a state prior to assessments. One of the primary insurers in California recently changed its top manager, along with its strategy, placing homeowners in a predicament. The prior strategy implied buying market share with unsustainable premiums. The new management team is choosing to write only profitable policies, so raised premiums and canceled policies just before the fires in Los Angeles. Many homeowners were pushed into FAIR policies. In Florida, Citizens Property Insurance Corporation is a government entity and can assess policyholders if premiums are insufficient. Florida suffered from various bad actors in the past. raising premium rates for all. And some new entrants have entered the market with below market price premiums and not survived their first event. Those living in at-risk areas can lower premiums by avoiding replacement cost policies and underinsuring their home. But this is a dangerous game. While individuals can prepare or harden or mitigate against fire risk, it's more effective when the community jointly mitigates the risk. Many issues involve difficult choices. If an area repeatedly floods, should it be rebuilt the same, develop updated building codes, or be abandoned? Insurance is so important to homeownership that for an area to be uninsurable means it is unlivable. Climate is changing, and feedback loops due to permafrost and the albedo effect are accelerating the warming trend. We live much closer to nature as populations grow. Extreme weather events are occurring more frequently and with more severe outcomes. Consumers view insurers poorly, often based on previous claim decisions that are deemed unfair, and trust needs to improve for insurers to champion sustainable practices. Nudges like higher premiums discourage risky behavior, while mitigation efforts to lower the risk can also reduce premiums. Policy exclusions include war, terrorism, mold, earthquakes, and flooding. Government provides insurance options for some of these and may work alongside others to provide disaster funds. Insurance policies can be designed to encourage specific behaviors. For example, an increased deductible may be required. An insurer can reflect higher risk by choosing not to offer a policy. Insurers can also proactively work with government to lower the risk, either by working with the insurance department or suggesting infrastructure improvements such as outdated sewer systems being replaced. Typical of seemingly all risks, those most impacted are the most vulnerable. At-risk areas are typically cheaper to live in and often are underinsured or not covered at all. This isn't always the case, as the fires in LA show, but lack of resiliency can leave them totally reliant on bailouts. The world is changing in known and unexpected ways as our environment evolves. Humans need to proactively prepare to build resilience before faced with a devastating event. Insurance can help the public understand the inherent risks and nudge behavior if allowed to transparently develop sustainable pricing practices. Realistic homeowner insurance rates will financially incent building to reflect the risk accepted, allowing optimization of decision making.
Max, recent trade policy debates and immigration policy have created uncertainty in many, many markets. Do you think that uncertainty impacts insurers?
Yeah, thanks, Dave. Tariffs will impact the cost of insurance in the future for sure. Car replacement parts, wood and steel to build homes, even appliances are all examples of insured things that tariffs will make more expensive to those repairing and building. So will be passed along to consumers eventually with increased insurance premiums and potentially increased cost sharing. It's likely that current immigration policy will reduce the number of skilled home builders with greater need for them due to more extreme weather events. Supply and demand ratios imply that they will increase inflation, decrease quality, and increase safety concerns as well.
Are there methods that can help insurers develop sustainable premiums as the climate continues to evolve?
Well, I think so. When historical results are no longer predictive, referred to as unknown knowns, as is true in many locations in insurance products today, insurers need to extrapolate those results as best we can. In the past, some insurance departments would not allow premiums to reflect anything but past experience, leading to the wildfire insurance losses in California, where drought and atmospheric rivers have been alternating to create excess fuel for burning. One simple method is to use first differences, where I might look at claims over the past 5 years, compare them to claims from 5 to 10 years ago, and assume that the same change would occur over the next 5 years. It's somewhat crude, but it gets you a place to start. Another method, building on climate modeling, is called attribution analysis. It compares a statistical distribution of recent experience to what would have been expected had fossil fuels not been extracted since the 18th century. Cumulative distribution functions then compare the area in the tail we see today against what we would have seen prior to the industrial age or against a period of the future. For example, a hurricane expected to generate 20 inches of rain, statistically, we can say it's 5 times more likely than it would have been, incorporating this information into our pricing models and into premiums.
Max, what do you expect to see in hurricane-prone areas like Florida? Is there a long-term role for private insurance there?
Well, any area with large claims sees a flurry of entrepreneur helpers descend on the state. We see it in Nebraska, where I am, when we have storms with wind, hail, and tornadoes. Some are enterprising small business owners, do great work, and charge a reasonable win-win fee. Others are scam artists and rip people off. It's unfortunately buyer beware for homeowners with contractors, as well as some new entrants into the insurance market. New companies charge below market premiums but are insolvent after the first big storm. Florida, similar to some other states, has created a public insurer for those who can't get private coverage for their homes. These need to use sustainable premiums to work over the long term. Sea level rise, warmer oceans, and a warmer atmosphere all lead to stronger storms that do more damage once they form. Building codes are improving, and that helps a lot with protecting new construction. What I don't understand is why building continues south of Orlando, especially in coastal cities, which are expected to have the sea recapture populated areas in the next century, with barriers mostly ineffective, so no walls, since the underlying land is porous limestone. Once the fresh water supply has been tainted, the cost of living in these areas will challenge people to live there.
Max, given the growing impact of wildfires in some areas, do you think insurers will start requiring more proactive resilience measures from homeowners and businesses as a condition of coverage? If so, what kind of measures?
Well, community resilience is more important than what one homeowner does. As Altadena and other areas near Los Angeles designed their rebuilding efforts, they need to be coordinated. One house in a neighborhood that hardens their exposure beyond updated building codes does almost nothing to reduce the overall risk. Communities need to update building codes to levels where insurers will agree to insure the area. This might require a buffer zone that's cleared of buildings to be designated where flammable material is cleared and power lines are required to be underground. There are many players, and they should all have an opportunity to comment before rebuilding begins. We talk a lot in ERM about balancing risks and returns, and this is just another way of thinking about it. We could build all buildings out of metal and have no trees or shrubs in the neighborhood, bury all power lines, and do other mitigation solutions that would make the area much less likely to burn. But that would be costly and could also lead to gentrification accusations, as we saw in New Orleans following Katrina. These are all tough choices. Dave, are there any international models for ensuring catastrophic risks that the U.S. could learn from, particularly in managing regulatory challenges and affordability?
Well, Max, as you may recall, I worked for about a dozen years for a London-based company. So I heard a lot about things that went on in the UK just as a natural course of events. One example I'll bring to everyone's attention is the approach that the UK took to flood risk. There were a number of seasons of heavy rains. I mean, the UK is known for a lot of rain anyway, but they got even more rain. And over the years, they had the same kind of building patterns that we have seen in the US, which is more and more building in floodplains and low-lying areas. So their exposure to flooding risk went up, rain continued, and some of the weather and climate changes that they've been seeing in the last 20 years have led to even more rain. So they've had flooding problems. In 2016, the UK created a government organization that it calls Flood Re. And it's a reinsurance pool that's designed to make flood insurance affordable for high-risk properties. And it's funded by a general tax on all household insurers so that the very high-risk householders are not forced out of their houses by unaffordable premiums. The kind of trend we're seeing in Florida. I mean, homeowners insurance in Florida costs multiples of what it does in a lot of other parts of the country right now, for instance, in the US. Transitioning to risk-based pricing and phasing out that levy is part of the plan, though, and it also includes plans to improve defenses against flooding. That's different than the approach we've seen in a couple places in the U.S. with the reinsurance pool that exists in Florida and the earthquake pool that exists in California. Those are both permanent things, and I think I really like the idea. The target in the UK for phasing that out is 25 years. That's enough time to make some big changes, and it's also enough time to defer that transition more than once. But we'll see what happens. As we wind down, I want to point out a few key takeaways. Emerging risks aren't on the horizon anymore. They're here, and they're picking up speed. That's putting serious pressure on the way insurance markets have always worked. We talked about how regulators who insist on only using past data can actually make things worse, not better, especially when the environment is shifting under our feet. Trust is another big theme. People don't always believe insurers are playing fair, and that gets harder when prices jump and the logic behind those jumps isn't clear. But we also saw that there are ways to build something more sustainable. Transparency helps. So does pricing that reflects the risk, even if it's not comfortable. And we need to think bigger than just individual homes. Resilience really happens at the community level, with building codes and planning and coordinated effort. There's no silver bullet, but there are promising ideas out there. Flood Re in the UK, for example, shows what can happen when you take a long view and try something new. It's going to take that kind of thinking, long-term, flexible, and collaborative, if we want insurance to keep playing this role in a riskier world. Thanks for listening, and if you enjoyed this episode, please like, subscribe, and share it with your friends and coworkers. Thanks. Bye.